I've got 3 ways to plan around the hidden HSA death tax. Hi, this is financial planner Sean Mullaney. Let's discuss. So first off, what the heck is the hidden HSA death tax? Well, the HSA death tax applies anytime an individual who is not one's spouse inherits an HSA, a health savings account. Folks don't know about this, right? So here's what happens. If you leave your health savings account to any individual who is not your spouse, they need to include in their taxable income the entire fair market value of the health savings account in the year of your death. Whoa, that can be massive, and that can create a big tax headache for them. For example, that income increases their modified adjusted gross income. And as we know, a lot of the benefits in the tax code are tied to one's modified adjusted gross income. So not only might your beneficiary be taxed on that amount, they may be disqualified from certain tax benefits. For example, they may be disqualified from the ability to make an annual Roth IRA contribution because inheriting that HSA may have kicked them into a modified adjusted gross income position that makes them ineligible to have made the Roth IRA annual contribution. All right, so what do we do about this hidden HSA death tax? Well, I've got 3 planning techniques that can help mitigate or hopefully avoid this death tax. Here's the first. Generally speaking, for most married individuals, naming their spouse as the 100% primary beneficiary is a great workaround the HSA hidden death tax. So what happens when you name your spouse as your 100% primary beneficiary on your health savings account, they inherit the health savings account as an HSA, as a health savings account upon your death. So it stays as an HSA and it's fully tax-free to your spouse. So that's a great first step in terms of planning here, right? Let's make sure we're leaving our HSAs to our spouse, right? It's hard to see much in the way of drawbacks of that tactic. All right, well, not everyone's going to be married when they die, right? So what else could we do? Second thing we can do is we can, during our lifetime, especially as we get older, take distributions from the HSA and one, either use them to pay qualified medical expenses, or 2, take them as tax and penalty-free reimbursements of what I refer to as PUQME, previously unreimbursed qualified medical expenses, right? So if you look at the HSA rules, they say once you have that HSA in place, all your future medical expenses and that of your spouse, of your dependents, those things can be reimbursed tax and penalty free. So why not keep some records? And then later in life, after the HSA has had time to have years and years and years of tax-free growth, we love that, we take the money out of the HSA. Why do we do that? We do that, one, because it's going to be tax and penalty free. We just say, oh, this $500 relates to this weekend warrior injury I had 20 years ago. I went to the doctor. I got some x-rays. They gave me a medication, whatever it is. They gave me a cast or whatever it is. That cost $500. Well, now I'm going to take that as a reimbursement, tax and penalty free. The nice thing about that is when you leave it, your assets to a non-spouse, and that $500 is just in your checking account or a taxable brokerage account instead of being in the HSA, it's tax-free to your heir. So that could be your kid, that could be a sibling, that could be a niece, nephew, grandchild, whoever it is. They would rather inherit that money inside a taxable brokerage account, checking account, savings account, investment account, whatever it is. They'd rather inherit it that way because it's income tax free to them if they inherit it that way versus inheriting it inside your HSA. So reimbursements of what I refer to as PUQME, previously unreimbursed qualified medical expenses, that's a great way to help avoid your heirs avoid this hidden HSA death tax. Here's the third way to think about mitigating this. It's to name an HSA or name the primary beneficiary on your HSA as a charity, right? Why do we do that, right? So if we're not married, so we don't have any spouse, we can leave this to tax-free. All the individuals in our lives we could leave this to are going to pay tax at their highest marginal rate, generally speaking. But if we leave it to a charity, we're otherwise charitably inclined, charity doesn't care about income tax, right? They don't pay income tax on that sort of thing. They just take the assets in the HSA and just goes into their general account or whatever, but they don't have, charities don't have IRAs or HSAs or any of that stuff. So they now have the money and they can use it for their charitable mission. All right. And nobody paid tax, right? So thinking about one's assets as they're getting later in life and thinking about, well, wait a minute, if I were to die, what would these assets look like and how would they go to my heirs, particularly if I'm not married? My heirs probably love inheriting Roth IRAs. Many of them are just going to have to take that out over 10 years, but it's fully tax and penalty free. That's a great asset to inherit. Or maybe it's a taxable brokerage account. Step up in basis at death. People love that. And it's tax free to them, right? So that's a great asset to leave to individuals who are not your spouse. But the HSA is fully taxable in the year of death. So maybe the HSA goes to the charity, the Roth, the taxable brokerage, even a traditional retirement account, probably going to be better to leave to an individual, certainly than an HSA, right? You might want to do some planning on particularly traditional retirement accounts. There could be some opportunities. But, the HSA death tax, it's out there. I think it just hasn't come to the forefront because so many HSA users are young. So fortunately, not many have died. And even for the ones who have died, maybe they had a spouse or maybe the balance was, a couple $1,000. So yeah, it stinks to put that on a tax return, but if somebody dies, that's a much worse problem. I think this is just something that has not been noticed in the personal finance space. I hope it's going to get more attention, and I think it can be planned around through these 3 tactics that I've mentioned in this video. Hope you enjoyed the video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.